Welcome to the True P&L Deep Dive. Before we start, a quick disclaimer. This analysis is for educational purposes only and does not constitute financial advice. Always do your own research. Now, let's get into the numbers.
Today we're diving deep into John Keells Holdings, looking at their H1 2025-26 results. And our goal, as always, is to get past those glossy press release figures and really unearth the true P&L.
Exactly. We want to find the underlying economic reality here, what's actually happening with cash flow, liquidity, and, genuine shareholder conversion.
And this H1 period, it really stands out. It feels like what you'd call a watershed moment for JKH.
It does. The company is right in the middle of these huge capital-intensive strategic pivots. You've got the City of Dreams project, the big scale-up in the retail division.
So the mission for us is to figure out if these big moves are structurally sound, if they're beneficial in the long run,
Or if they're just creating a lot of operational noise that might be masking some real financial strain underneath. And the headlines, they give us the first and maybe the biggest contradiction we have to dissect today.
That contradiction is really the perfect place to start. It's the foundation for this whole deep dive, and we've been calling it the Great Profit Divergence. Or, maybe more pointedly, the NCI Trap.
Let's lay out the numbers then, the ones that hit the news wires and get the market all excited. First up, revenue for the period is up a monumental 77% year over year.
Just a huge number. It cleared R's $258.9 billion.
And then if you look at the operating leverage, which we'll get into in a bit, that propelled profit before tax, the PBT, up by a staggering 427%.
427%, up to R's $10.9 billion.
So on the surface, these are just incredible growth figures. It's the kind of performance that screams exceptional execution, maybe a huge market tailwind.
It is. But the mission of the True P&L Dive is to look past that PBT number to the figure that really matters to us as equity analysts.
The one that actually belongs to the shareholders.
The profit attributable to parent shareholders, PEEHD.
And this is where the story completely changes. When you filter that incredible 427% PBT growth down to the parent line, the growth rate it falls off a cliff.
It decelerates dramatically. While PBT soared, the PBT-EH grew by only 70%.
And landed at, frankly, meager R's, $849 million.
The scale of that divergence is what's so crucial here. Total profit, before you do any allocations, surged by nearly 785% compared to last year.
785%.
But the equity holders, the parent shareholders, they only captured 17% of that total profit increase.
17%. So that's the first big signal, right? That JKH's profit engine is now structured in a way that disproportionately benefits external partners.
And that immediately points our flashlight toward one line item, the non-controlling interest, or NCI. This is the mechanism causing that allocation shock.
So let's look at the NCI line. It really provides the whole explanation. The profit allocated to these non-controlling interests didn't just grow.
It exploded. It surged by an astonishing 7,115%.
7,115%.
It's an almost unbelievable figure. It settles at R's 2, $4.07 billion for the half year. And it just highlights this massive structural realignment of the entire conglomerate.
A growth rate over 70 times the prior period. That demands scrutiny. And we know exactly where this is flowing.
We do. The source material points directly to the success of the joint venture partners in the John Keells CG auto business.
Which is structured as a 50% joint venture.
Exactly. So when a 50-50 JV performs exceptionally well, half that profit, legally and structurally, belongs to your partner. It has to be allocated away from the parent's consolidated income statement.
So the operational success in the auto business is very real. They're selling a lot. But the economics of the ownership structure mean it's shared equally.
And because that business segment delivered such spectacular results, the NCI burden just became immense.
So just to be crystal clear for anyone listening, NCI isn't an expense like interest or tax. It's a subtraction. It's a slice of legally owned profit that gets taken out before you arrive at the parent's actual bottom line.
And the final, critical statistic that really defines this whole H1 period is that NCI accounted for 82.7% of the total profit generated by the group.
82.7%. That statistic is the whole issue right there.
It is. It means that while JKH has successfully switched on these massive new growth engines, about 8 out of every 10 rupees of total accounting profit is bypassing the ultimate equity holder.
Which is what we're calling Advanced Investor Lesson 1.
You have to be skeptical of headline PBT growth, especially in a complex conglomerate that relies heavily on high-performing JVs. The NCI Trap has fundamentally decoupled the group's profitability from the parent shareholders' returns.
I think the critical counterpoint here, though, is Well, is this NCI burden just the necessary cost of getting that structural advantage in the first place?
That's a great question.
I mean, could JKH have even achieved that 56% EBIT contribution from the retail sector without leveraging a 50% JV structure? Wouldn't the capital outlay, the market entry risk, have just been far too high to go it alone?
That's the strategic question, isn't it? The JV structure most likely allowed JKH to get into the highly capital-intensive auto market very quickly. They could leverage the partner's expertise, maybe their financing.
Right.
So while that 82.7% profit leakage is painful to look at now, the alternative might have been, zero growth from this sector.
So the trap isn't that the JV exists.
No. The trap is that the success is so overwhelmingly concentrated in this one specific structurally diluted segment. We've got excellent operational control, but the financial allocation is, let's say, unfavorable.
Understood. But we can't let that NCI track completely overshadow the fact that operationally, something pretty remarkable happened inside JKH. The efficiency engine is running hotter than it ever has.
Precisely. Let's move to the engine room now. The mission is to determine if that 77% revenue growth was achieved by, say, aggressive discounting, or if it represents true operational excellence.
Selling more at better prices and managing costs exceptionally well.
And the numbers seem to confirm its genuine strength. We can start with the revenue and gross margin analysis. That huge 77% revenue jump is incredibly difficult to manage without some margin compression.
Especially in an inflationary environment, yeah.
Yet JKH actually improved its gross margin. It rose to 19.3% compared to 18.5% in the prior period.
That's an 80 basis point increase. That's a really clear signal of either robust pricing power, meaning they can pass costs on to the consumer,
or superior management of their really complex supply chains and bulk purchasing. Either way, it's strong.
That's a great foundation. But the real test of efficiency, it lies in how they control their fixed costs and overheads, their SG&A expenses.
The heart of operating leverage.
Exactly.
And this is where the performance flips from just strong to, frankly, spectacular. Their operating margin surged from 1.95% in the prior half year all the way to 6.1% this period.
That is almost a threefold increase in operational profitability. Operating profit itself surged 453%, hitting Rs $15.8 billion.
And this is where that 427% PBT headline really comes from. We can attribute this to two things: massive operating leverage and exceptional cost control. To explain the leverage part specifically for JKH, operating leverage is just maximizing revenue per unit of fixed costs.
And JKH is a structurally capital-intensive company. You just have to think of the port operations, massive upfront costs for dredging, cranes, terminals, or the new leisure properties, which have huge long-term leases or ownership costs.
That's the perfect example. Whether a port terminal is running at 20% capacity or 80% capacity, the cost of that facility, the core staff, the long-term debt on that infrastructure, it all stays relatively fixed. So when JKH gets a 77% surge in top-line revenue, it means they've successfully pushed utilization way past the break-even point on these major fixed assets.
So every new container handle or every extra hotel room booked just drops the cost per unit dramatically.
It drives that marginal revenue almost straight down to the operating profit line. The operational machine is just running at peak efficiency relative to its fixed costs.
Okay, so the operational excellence is undeniable. But we already know this incredible performance didn't really convert to the parent's bottom line because of the NCI. So now we have to investigate the profit leakage that happens after operations.
The leakage between that Rs $15.8 billion operating profit and the final PATH.
Exactly.
The first, and it's a smaller element of leakage, is the finance costs line. This item flipped from being near zero, or even a gain last year, to a Rs $260 million expense this half.
Okay, so $260 million isn't enough to kill $15.8 billion in operating profit, but it does signal a change. What's the implication there?
It suggests the absolute cost of funding went up, even with their strong solvency position. It could be a rise in local short-term interest rates, hitting their working capital borrowings.
Or maybe, adverse currency exposure on foreign loans for big projects like City of Dreams.
That's also a possibility. Either way, it's a necessary funding cost that just chipped away at those operational gains.
But the real structural issue, the dominant profit sinkhole, is still that allocation mechanism we started with.
Absolutely. You start with $15.8 billion in operating profit, you chip away the finance costs, and then you're forced to allocate over 80% of what's left to your external JV partners.
The operational strength is just not structurally aligned with the equity holders' interests at this point in time.
And the proof is right there in the margin conversion. Despite that soaring operational margin of 6.1%, the net margin to the parent, it's virtually flat.
And exceptionally low.
0.33% this year compared to 0.34% last year.
That metric is the cold, hard reality check. It confirms that all those exceptional gains from revenue growth, better gross margins, and massive operating leverage were completely nullified.
Wiped out by the combined pressure of financing costs and that structural NCI allocation.
The company is operationally brilliant, but its current structure prohibits the conversion of that brilliance into meaningful growth for shareholders.
So to understand why this NCI trap persists, we have to look at where that $15.8 billion in operating profit is actually coming from. The sources show a pretty significant, and you could say risky, strategic shift in the conglomerate's center of gravity. JKH is fundamentally transforming. I mean, historically, their core strengths were always in transport the ports and their legacy property holdings.
But the new engine is somewhere else entirely now.
And it's largely driven by strategic choices they made over the last few years. The new center of gravity is indisputably retail, specifically that high-performing auto JV.
Right. The retail segment now accounts for a staggering 56% of group EBITDA.
56%. It contributed our $17.4 billion. That one figure alone explains the entire NCI issue. More than half of the group's operational vitality is concentrated in a segment where JKH only keeps 50% of the financial return.
And that presents a strategic risk profile that investors really need to think about. I mean, a 56% EBITDA concentration in one segment shows amazing execution, sure.
But it also means JKH's overall financial profile is extremely vulnerable to that one sector's market cycles.
Whether it's currency availability for car imports or just domestic demand for high-value vehicles.
It creates this kind of peculiar dual dynamic. The group is de-risking by diversifying away from its legacy slow-growth segments.
But the parent company is actually increasing its reliance on a segment where its return is structurally diluted. It's sort of a necessary evil of this expansion phase.
Beyond the retail giant, though, we do see some really encouraging signs in what we're calling the high-stakes bets. These are starting to show genuine recovery.
And they're likely to be higher quality, less diluted profit for the parent. Leisure is the standout here.
The traditional leisure segment, and this is excluding the Big City of Dreams project, showed an excellent recovery. EBITDA soared 126% to Rs. $2.32 billion.
That's a classic post-crisis rebound. We're probably seeing high occupancy rates, successful rate management.
It suggests the market is recognizing JKH's premium hospitality assets. And crucially, this is high-quality profit that mostly sticks with the parent.
And then there's the elephant in the room, CODSL, the City of Dreams. For years, the market has worried this project would just permanently swamp the balance sheet.
But according to the sources, it looks like it's finally turning a very important corner.
Which is a massive de-risking event.
It is. The loss narrowed significantly. It dropped from Rs. $1.96 billion in the prior period to Rs. $1.06 billion this half.
So that's about a 900 million rupee improvement in just 6 months. It's still consuming cash, yes, but the path to break even now looks plausible. It's not just aspirational anymore.
I think the psychological factor here is just as important as the financial one. A billion rupee reduction in losses removes a huge source of anxiety for investors about the viability of this massive investment.
It probably frees up a lot of management attention that was just dedicated to crisis mitigation before.
Absolutely. And the success of this loss narrowing is critical because as the operational performance improves here, it converts almost entirely to the parent's benefit, unlike the auto JV.
Right, because Sakad GSL is a majority-owned asset, so when it eventually flips to profitability, the impact on POT-TH will be substantial and immediate.
Conversely, we should just briefly note the laggards. Not every segment is firing on all cylinders.
Transport and consumer foods were relatively flat, maybe saw slight declines.
And while they provide diversification and some stable cash flow, they're just not the growth drivers anymore. The story for JKH now is clearly centered on these two major structural pivots.
The retail auto JV delivering the volume.
And the leader KDSL project delivering operational improvement and, maybe more importantly, risk reduction.
Okay, so we've established it. Fantastic operational performance driven by leverage and strong sectors, but the conversion to parent P&L is poor because of NCI and finance costs. So now let's pivot to what you call the most brutal truth in finance.
The difference between accounting profit and real cash.
This leads us straight to Advanced Investor Lesson 2.
Cash is inherently superior to accounting profit. It's simple. You can't pay interest or dividends or reinvest for growth with PBT. You need cold, hard cash.
And the divergence here is, again, staggering. It's the ultimate reality check for that 427% PBT growth number. While PBT soared, the operating cash flow of the CFO actually fell.
It fell 6.6% to ours, $2.85 billion.
So how is that possible? How can a company's operational profit surge by over 4 times, yet the cash generated by those operations actually declines?
The immediate answer almost always is working capital consumption. It's the silent profit killer during aggressive growth phases.
And we need to deep dive into the specific cause of this cash flow drag. The source material flags it as the inventory shock.
And the shock is massive. In just 6 months, inventories jumped by ours, $16.6 billion. That's a 42.8% increase.
Bringing the total stock they're holding to ours, $55.3 billion. This is the primary reason the company is so cash thirsty right now.
And you have to link this right back to the retail segment, to that auto JV that's contributing 56% of EBITDA.
Right. When JKH sees this massive demand for imported high-value items like cars, they have to commit huge amounts of upfront capital to import them, clear them through customs, and then hold that inventory before the final sale is even recorded.
That's the mechanism perfectly. The accounting profit gets generated when the sale is recorded on paper. But if the inventory turnover is slow, say a high-value car sits on the lot for 3 to 6 months, the cash from that sale lags way behind the profit calculation.
So rapid growth forces the company to aggressively reinvest every single rupee of available cash straight back into the balance sheet to fuel the next cycle of imports.
The sources call this the cost of growth. But we have to analyze the implications. The Rs. $16.6 billion jump in inventory suggests JKH is making a huge bet on sustained aggressive demand.
And if that demand slows down for any reason, that inventory becomes a stranded asset. It could severely damage cash flow in future periods.
The risk is all about timing. JKH is in this high-risk phase where they're maximizing operational efficiency but minimizing cash flow conversion. The catch is just tied up. And this is immediately visible when we calculate their free cash flow, or FCF.
Okay, let's run the FCF deficit for the period. FCF is your operating cash flow minus your capital expenditures, your CapEx.
JKH's CFO was Rs. $2.85 billion. But their CapEx commitment for the period investing in long-term infrastructure, probably still building out CODSL and other properties, was Rs. $6.09 billion.
Which gives you a free cash flow deficit of negative Rs. $3.24 billion.
Negative FCF. This is a critical finding. Despite that amazing operational performance on paper, JKH is fundamentally a net cash consumer right now. It is burning cash.
It's burning cash to finance its inventory buildup and its aggressive long-term investment strategy.
Their cash conversion ratio stands at 58%. The sources rightly call this weak. But importantly, they do clarify it's not due to, fake profits. It's the necessary working capital consumption.
Still, as an investor, you have to monitor that ratio relentlessly. A weak conversion ratio coupled with a massive PBT suggests the time it takes to turn sales into cash is getting longer, which puts continuous pressure on liquidity.
So the operational strength is real, but the price of that growth paid in working capital and CapEx is currently overriding the cash generation capacity. The company has to turn to its balance sheet to bridge this deficit.
Which brings us to the balance sheet. To understand how JKH funded that negative 3.24 billion rupee FCF, we have to look there. Let's start with the good news, the structural strength.
Overall solvency is robust, and that provides a pretty important safety net against these short-term cash pressures.
Total assets are healthy at Rs. 889.7 billion. Their net debt to equity ratio is very manageable at 28.7%.
And their interest coverage ratio, how many times their earnings cover their interest expenses, is described as rock solid at 60.9 times.
That 60.9x coverage is really impressive. It suggests that no matter what happens with short-term interest rates, JKH's current earnings can more than cover their debt servicing costs.
From a long-term structural debt perspective, JKH is exceptionally well-managed and solvent. There's no crisis there.
However, the story gets a lot darker when we shift from that long-term solvency to short-term liquidity. This is where the red flags from the inventory shock and the negative FCF really start to show up.
We have to analyze this deteriorating short-term position. Start with the current ratio. It fell from 1.23x down to 1.09x.
So it's still above the critical 1.0x mark, which means current assets technically exceed current liabilities. But the downward trend is a concern.
But the more sensitive metric, the asset test or the quick ratio, is where the structural weakness really becomes clear. This ratio excludes the least liquid asset, all that inventory from the calculation.
And the quick ratio fell significantly. It went from 0.97x down to 0.81x. The source material really stresses the importance of this metric falling below 1.0.
It's a critical threshold failure. It means JKH cannot cover its short-term liabilities solely with its most liquid assets, cash, receivables, short-term investments.
Not without selling off a portion of that massive Rs $55 billion inventory stack.
Exactly. It confirms that the inventory buildup is both a cash flow drag and serious near-term liquidity stressor.
The inventory shock is acting as a major constraint on their financial flexibility.
And this pressure explains what we're calling Advanced Lesson 3, the debt mix. It's how JKH funded the negative FCF and that huge working capital requirement.
This is the kind of subtle shift that senior analysts have to spot. So on the positive side, JKH successfully paid down Rs $24.5 billion in long-term debt. That's great for structural de-risking.
But the trade-off for that, and to cover the negative FCF, was that they had to go out and borrow Rs $23.8 billion in short-term debt.
So they essentially swapped stable long-term financing for immediate high-turnover debt obligations.
Right, and the strategic implication of this shift is that it's a liquidity red flag.
It increases refinancing risk dramatically, doesn't it?
Massively. While their total leverage is still manageable, having a huge Rs $23.8 billion pile of short-term debt means JKH is highly exposed to any sudden tightening of market conditions or unexpected interest rate hikes.
They're making a bet that they can roll over or pay down this short-term debt before those pressures really materialize. It's a trade-off. Increase short-term risk to stabilize the long-term structure.
Finally, let's just revisit the equity side. The stagnant book value. Despite all this massive operational growth, the net asset value per share, the NAV, is basically flat. It moved from Rs 22.58 to just Rs 22.67.
Zero meaningful growth in shareholder equity.
And we know exactly why. The profit that did manage to reach the parent shareholders, that Rs $849 million, it was immediately offset by a dividend payout of Rs $881 million.
So JKH is actually distributing more cash to shareholders than it's generating in parent-level attributable profit.
Precisely. They're not retaining any earnings to compound and grow the underlying equity base. And this results in an exceptionally low parent return on equity, ROE, of just 0.42% on an annualized basis.
A sub-0.5% ROE for the parent is just not a compelling argument for a long-term equity investment, regardless of the strong solvency and operational hustle.
And the group return on assets, the ROA, is also structurally low at 1.13%, but that's just inherent to the capital-intensive nature of their assets, ports, property, hotels.
So the takeaway from the balance sheet is clear. JKH is not facing a solvency crisis, but it is facing a severe short-term liquidity crunch.
And it's driven entirely by its aggressive growth strategy and its investment needs. The company is actively consuming cash and financing that consumption by swapping long-term debt for higher-risk short-term debt, all while failing to retain any earnings to grow its equity.
Okay, let's bring it all together. We've dissected the P&L, the cash flow, the balance sheet, all to find the true P&L. And JKH's H1 results tell a story of two fundamentally conflicting narratives.
The positive narrative is all about execution and solvency. The revenue growth is real. The operational core is exceptionally strong. We see that in the massive operating leverage and the margin expansion.
And long-term solvency is rock solid. They've successfully reduced those high-risk losses in CODSL. They are executing their growth strategy.
But then there's the negative narrative, which revolves around conversion and liquidity. The group is FCF negative. It's consuming cash because of that aggressive Rs $16.6 billion inventory investment.
And structurally, 83% of total profit bypasses the parent shareholder because of the NCI Trap.
And this non-conversion has led to tangible financial risk. The quick ratio is below 1.0x, and the debt mix has dangerously shifted towards short-term refinancing exposure.
So therefore, the entire investment thesis has pivoted. It no longer relies on whether JKH can generate profit. We know they can, operationally.
The question is whether they can convert that profit. Future returns now hinge entirely on one question. Can the high-stakes ventures, specifically the Retail Auto JV and the City of Dreams project flip, from being aggressive cash consumers to self-sustaining cash generators?
And they have to do it within the crucial next 12 to 18 months.
If they fail to make that pivot, the company stays trapped in this cycle, generating impressive paper profits that don't benefit the parent,
while simultaneously requiring continuous high-risk short-term debt just to cover the widening working capital gap. The operational strength has to finally become a cash flow story.
And the key indicators you need to watch are simple. First, you need to see JKH hit break even. That eliminates the R's. 1.06 billion loss, which is high-quality parent-level profit recovery.
But more critically,
The auto JV has to stabilize its inventory growth rate. If revenue keeps soaring but the inventory growth slows down, that's the first sign that the working capital pressure is easing and cash conversion is finally improving.
and this brings us to our final provocative thought for you, the serious investor. We've analyzed the consequences of this NCI trap, that 83% leakage, but we haven't asked the deeper structural question. Given the overwhelming and sustained success of the auto JV, which now completely dominates group EBITDA, has the JV structure itself become financially obsolete?
You mean, is the leakage so significant that management must now explore the radical, expensive, but maybe ultimately necessary option of buying out the JV partner entirely?
Exactly. If the parent company could achieve 100% ownership of that high-performing segment, that 83% leakage disappears. That $4 billion in NCI profit would flow directly to pay EH.
The capital cost would be enormous.
Mhm.
It would likely require huge new debt or a massive equity issuance, but it would instantly correct the structural flaws in JKH's P&L and unleash the full potential of their operational excellence.
That's the ultimate trade-off for management to consider over the next year, bearing the short-term financial pain of zero retained earnings and high debt refinancing.
Versus enduring the long-term pain of constant profit dilution.
Watch the inventory, watch the quick ratio, and consider if the price of freedom from the NCI trap is worth the cost of a full buyout. That's your true P&L.